Hi everyone, welcome to this live show. I will try to resume or restart what I started in the morning. I did not work. Today we are going a bit late, but here we are, right? I'm going to share with you all my view of the market, what we can expect from EOS this week, both fundamentally and technically. Of course, I will start by sharing the calendar, but you know how things are. Everything is about Brexit and what's going on in the UK and the economical and political future of the kingdom ever since the Leave side won the referendum over a week ago. The fact is that we had some data days and a quiet start Monday with the US on holiday, but ever since the past Asian session started, risk aversion has been once again dominating the markets. When it comes to data, so far today, we had a nice service PMI in China, right? A bit encouraging comparing to previous, going higher. And the Reserve Bank of Australia left its rates unchanged, okay? But somehow Governor Stevens hinted some further easing in the future by saying that he's waiting for upcoming inflation data before taking a new decision, right? The bank has stayed on hold for the second month in a row, but after the upcoming quarterly inflation report of Australia, if the numbers are disappointing, it will probably cut rates again. One thing that happened earlier today is that if you take a look at the calendar, all of the services and composite PMIs from Europe were pretty nice because we got them all in green, right? But the fact is that the region is growing at the slowest pace, right, in over almost 2 years, I do believe. So these green numbers are not that green, and that's why the euro is unable to rally beyond what's going on with sentiment. Okay. The other thing that we should remark about what happened and what will happen, it's the UK. You know, we have the construction PMI on Monday, and today we have the services PMI, both below expected, both below previous. The services one, not as bad as the construction one, which was pretty negative. But what's interesting about these two reports is the fact that the survey, the data, has been taken a couple of days. We have data including a couple of days before the referendum, and that's why we have those strong declines. It's actually important is that is going to keep on disappointed in the UK today and the upcoming days and the upcoming months, probably, as uncertainty, as I said before, about the future, right, will probably keep business out of their highs. Okay, not new investments are expected in the UK anytime soon. Anyway, Governor Carney spoke today. His words were quite encouraging because it sounds like at least the Bank of England has a plan. It doesn't sound like the government in the UK has a plan, but at least the bank has one, and they are ready to inject liquidity, cut rates, or use any other tool available to counter-arrest the chaos that this Brexit may trigger. Overall, Carney sounded far more confident than any other authority in the UK. Anyway, and for the days to come, I do believe that tomorrow's Draghi's word will be in the spotlight, right? On anything he could say about the future of the euro area with this new scenario triggered by the United Kingdom. There's a good chance that the euro area may have to extend existing, although nothing official has been said yet about this. But still, I will be watching closely whatever Draghi has to say, if there's any changes in his wording as of late, right? We also have the minutes of the latest Fed meeting. Actually, I don't consider this to be too relevant because, you know, the meeting took place in June, and these minutes are from that meeting, sorry. And well, Brexit has been a big game changer, right? So at this point, the market is, I don't know, thinking that the Fed won't be able to rise rates this year, and with some luck, maybe by the end of 2017, right? With some luck. So that's what the market is thinking about. And I don't believe that the past meeting minutes can be able to change that feeling, right? As I always said, any Fed decision rests in two legs. One is inflation, one is employment. So at least unless we see inflation picking up in the United States, I don't believe the Fed will be planning any rate hike anytime soon. On Thursday, we have industrial and manufacturing data in UK. I believe it is among the most relevant, and the minutes of the ECB. This too may be encouraging or not, but given that this is May data, I don't expect them to affect much the market, right? However, if the numbers are disappointing, even before the Brexit, right, that will be another hit for the pound. Beware of that. And the minutes of the latest ECB meeting, I don't expect them to be a shocker one, because we will have Draghi talking on Wednesday, and we will probably anticipate most of what we can read in these minutes on Thursday. Finally, on Friday, the start of the month, as always, the non-farm payroll report. Expectations are of a sharp recovery in the employment sector, right? Although unemployment rate is expected to tick modestly higher. Anyway, something anywhere below 5, I do believe it's a huge positive reading, right? And if we had a headline matching this 178 or better, I would expect that to be quite encouraging from the greenback, but maybe not enough to put it on a bullish trend by itself. As I said, I do believe that inflation in the United States is the key, right? Not just employment. And additionally, after the quite disappointing number we have last month, this a good number by its own, it won't be enough to put the greenback in a bullish trend, right? Anyway, let's take a look at charts. Of course, the first thing you see is that the pound is steadily approaching to 130, fresh lows. But let's start with the euro. We have a modest bullish trend in here, right? Really modest, because ever since referendum, the pair has been doing pretty much nothing. It's just the second week. We had a pair trading in between 1060, 1180, 1190. In fact, the post-Brexit referendum high is 1189. We tested 86 today and quickly recovery. So despite this modest bullish trend we are seeing in the year, the fact is that we don't have any momentum, right? I'm not seeing much of an upward potential right now, although the pair is correcting higher ever since testing 910 or so a couple of Fridays ago, right? Anyway, I would like to see the pair, as I said, breaking above this post-Brexit high 1190 region and accelerating above this level to think about a bullish trade in the short term, of course, up to this 1240 price zone where we have multiple highs and lows, intraday ones from the past, and follow then for the 11280, 113 region. I do believe that's the highest we can see the pair. Somehow the dollar tumbles either with negative data or an improvement in risk sentiment, right? Also in the forward charts, what I'm seeing in here is that the 20 simple moving average is leading the way higher, right? It's offering sort of a dynamic support intraday ever since mid last week, and it currently stands around 1125, and it's losing its bullish trend, right? But what makes me think that if we open a forward candle below this level, or if we see a price acceleration through the moving average, we can see the pair resuming in its decline, right? In which case, I do believe that we can reach easily 1050, which was the comfort zone for the price for most of last week. Below that level, I do believe that approaches to 110 are likely, but some buying interest will probably lie in there, right? So maybe we need a clear break below 970 to see a pair resuming its line back to this low and even lower. To be honest, despite whatever the future brings, I don't see the pair easily breaking below 1.0800, which has been a major static support for most of this year, right? Jumping into the pound, the fact is that we are at 31-year lows, I have no memories of, of whatever happened in the past year, but the pair is clearly heading towards 130, right? Sentiment towards the pound keeps deteriorating, and there's nothing that anyone can do about this, okay? I suspect that if a pair breaks below 130, we're going to see large stops getting triggered and therefore the decline accelerating. At this point, I don't find crazy the fact that pair can reach 128 this week, right? And further moves if we break below 130 and lost a couple of hundred pips will depend on how the pair reacts. Meaning, if we get to 128 and the pair bounces modestly, maybe 20, 50 pips, that would probably indicate that there's scope for further slides. So beware that the pair can extend then down to 125 during the upcoming weeks. If, however, we test 128 and pair bounce strongly, then there's a good chance that it will return towards this 130, 131 region. Still, I won't be betting of longs in here. I don't believe that spikes or upward movements are corrective and an opportunity to sell, but maybe it's not my favorite pair to trade these days, except when it breaks below a figure 133, 132, 131, and so on, right? That goes for pound. Well, the pair has entered again a consolidated stage. It has been quite comfortable between 102 and 103, right, for most of the post-Brexit scenario. And it has resumed its light today, now trading at around the lows of its range. I believe that bearish trend in here is quite clear, and with stocks down and yields at record lows and demand for bonds rising all through the world, there's a good chance that the pair will break below 101. In fact, I'm expecting the pair to test 100. Of course, we have payrolls in the way, right? And that could be an interruption, at least temporarily, for any kind of trend we have in dollar Japanese yen. But overall, the risk remains towards downside, towards the 100 level. I believe, sorry, that the BOH won't be happy if the pair breaks below 100, and we'll start with usual showboating, and we're ready to intervene. We are going to add more stimulus, but the market will need action, right? An extension of quantitative easing or an actual intervention to think that the pair to stop buying the Japanese yen. If they don't actually act, a verbal intervention won't be doing much for the Japanese yen. Anyway, and in the short term, the immediate resistance stands at 100-10 for me. A candle opening or acceleration above this level can see the pair recovering up to the 103-103.30 region. Honestly, we have these lows 103.50, 55 from earlier June. Unless the pair recovers above this level, the upside seems also limited and the risk remains towards downside, and selling higher seems the way to play the Japanese yen, right? And when it comes to the Australian dollar and the Canadian dollar, they're both plummeting on the back of crude slide today. It has retraced sharply after testing once again 50, and of course tracking stocks that had been plummeting all through the regions, right? Early Asia, then Europe, and now in America. Stocks are under strong selling pressure. Appetite for risk resume. Gold, is recovering ground, and both the OC and the CAD are following. Still, when it comes to the OC, the slides, it's more limited than what it seems. I believe that we have a key level around 74.50, right, which is the 38.2% retracement of this year bullish rally, right? So it will take a break below this level to see the bearish potential increasing, with the next supports for me around 74.10 and 73.70. Okay, those are the short-term supports. If we lost the last, we can go down to 73.20.30, which is the next Fibonacci support. Also, a level that the pair has respected pretty much during the past June, right? Still, I do believe that the rate differential in between Australia and the US will prevail after the dust settles, and the risk in here in the longer term is towards the upside, right? Not for today, not maybe for tomorrow, and will happen Friday will of course depend on Fridays. But if we regain somehow 75, pair can go back to this highs of a week, 75, 46, and even higher and approach 76, 76.50, right? That's for this one. Oil, I do believe that we have talked plenty about oil in the latest videos. The fact is that I do believe that 50 is sort of an equilibrium level, right? The price will probably hover in between 45 and 52. There's not much upward potential beyond that 52 we had early June. I do believe that we are in a consolidated stage, and with they moves into the range for the coming days. Honestly, I'm not seeing a tough break lower. I'm not seeing a 40, neither 30 for the upcoming weeks, unless we have really, really bad news coming from the crude oil front, right? And we will not. I will expect some downward move in the short term, but stabilizing in the region we mentioned, 45, 52. And at least until the market has a clearer picture or completely digest whatever the UK will do and whatever the US will do with rates, right? When to gold, we have talked about this also, but I believe that we are generally bullish, right? After that sharp recovery up to fresh year highs after the Brexit, the following retracement held above, well above the 38.2 of that rally, right? And we are back pressuring highs as risk aversion resumed. I do believe that there's room for further gains in here, right? I'm watching this region, this highs from 2013, 1430 as a 1430 as a probable bullish target, not for today, not for tomorrow, but for the upcoming days. As I said, I still don't see it much more higher. I don't see a break above 1500. But of course, if a risk sentiment extends, we will probably approach that level during the upcoming months. Short term, right? I do believe that we have an immediate support in these previous highs and lows, 1335, the immediate one, but more relevant 1320, which is the first Fibonacci retracement of the latest run. And of course, these lows are quite relevant also because it's high 1305, 1303. So a break below it could see the metal turning sharp lower, although that will only happen if somehow the Federal Reserve of the United States announces a rate hike for, I don't know, maybe August, maybe September, which is, of course, extremely unlikely, but it's what the market is looking for, okay, to sell the gold. Sorry. Sorry. Okay, pretty much that's it for this week and what we can expect and levels to watch. I hope you enjoyed it as much as I. And next week, okay, I will be back in home. I will be back with my computer, with my connection, and with all my stuff. So hopefully, no more drama with internet from next week on. Okay, thank you. Bye bye. See you soon.